What's up, everyone? Welcome to the daily macro update for Thursday, August 21st. Taking a look at the S&P 500 here. It's on its third day of a consecutive decline here. It looks like the market is about to close in about 10 minutes, so we'll see if that happens. Interestingly, when taking a look at the volume dynamic, we can see here, let me see. This was on a pretty low volume day. Typically, when you see prices decline with volume also declining, that is what's considered a bullish divergence. So we'll see what happens when taking a look at both the 1 week average versus 1 month average volume. You can see that today was quite the decline. And so that's definitely interesting, especially heading into tomorrow's Jackson Hole speech, the last Jackson Hole speech from Jerome Powell as Fed chair. So we'll go ahead and take a look at some of the other market setups here. But getting into some of the macro data here today, we received the Conference Board's leading economic index. And so that continued to decline. This has pretty much been in decline, since 2021, really. So there's been a huge divergence, really the largest divergence that we've ever seen in this index, where the stock market continues higher while the leading economic indicators continue to decline, which has sparked a lot of people saying, are these leading indicators actual leading indicators? Yes, it's just that when you print $4 trillion in 1 month during a pandemic to bail out the entire economy, where beforehand it took you 100 years to go from zero to a $4 trillion balance sheet, and then you doubled 100 years of damage in 1 month by printing all that money, it's going to cause some crazy things to happen. So, should you be surprised that you're seeing a continued deceleration in leading indicators versus aggregate? No, not really, considering what they did. But when you take a look at the main contributors by percentage points on what's been contributing to this continued decline, it has been consumer expectations on business conditions, as well as manufacturing new orders, or manufacturing and services new orders. All right. We also received the existing home sales report here, which increased by 0.8% year over year. And then the median existing home sales price increased to $422,400. Now, of course, that's not the average, that's the median price. But when taking a look at some of the numbers here that they produced in their monthly report here, you can pretty much see that existing home sales have just been continuing to accelerate here and remains near all-time highs. Even though the rate at which prices have been accelerating has slowed down year over year, when looking at this on a nominal scale, let's go to home prices. As you can see, in 2025, you've had a very fast acceleration in existing home prices. If we go back 3 years, as you can see, this continues higher. And then, of course, if we want to go back the last 10 years, this has pretty much been a pretty large acceleration, right? So right now, home prices as a median is 435,000, whereas just back in 2016, they were 214,000. So pretty much in 10 years, home prices have doubled for existing homes from where they're at. That's a 100% increase in the last 10 years, or a 10% increase in home prices per year. That's kind of ridiculous. Is that 2% inflation? No. Did your wages go up by 10%? Like, did your boss give you a 10% raise every single year? I didn't think so. So, home prices continue to accelerate here. We also got the United States Manufacturing and Services Flash PMI from S&P Global. Now, what's interesting is that with the S&P Global numbers, you have manufacturing as well as services accelerate. Yet, we continue to see on the ISM front how both of these are decelerating. So which one is correct? You're getting diverging information there. When taking a look at the United States Philadelphia Fed Manufacturing Index, you saw a pretty large decline back into contractionary territory, led by new orders, while prices continue to rise due to the tariff situation. All right. Let's see here. And so, what this shows is that you have sorry, I was getting a phone call there. So what this shows is that you have a pretty large acceleration in prices here in red, while new orders continue to decline. The last time that we saw a separation like this was all the way back in September of 2021, and we also saw this back in 2008, specifically early 2008. So the last two times that the Philadelphia Fed Manufacturing Index did this, it wasn't. It was before bear markets. Not saying that's going to happen, but obviously this type of stagflationary environment, doesn't typically precede economic booms. If you just look at the past 20 years of recent history, but that's pretty much what I'm looking at in terms of the macro data today. What is very interesting is when taking a look at the target rate probabilities for the September Fed meeting, just 1 week, we went from a 98% chance of a 25 basis point cut to now a 73% chance of a 25 basis point cut. Let me zoom out a little bit. While in just 1 week, the chances of a pause remaining where we're at in terms of interest rates went from 0% 1 week ago to now a 26% chance. That's a massive swing, right? That's a whole 25-point swing from just 1 week to the other. So if you remember all these, I was getting screenshots and DMs from people, saying, look, there's a 95% chance. And I was like, wait a second, hold on. This thing could swing. There's still a lot of data that has to come into place, right? And really what the market has been pricing in is now they're realizing that inflation could remain stickier, right? Now, that still doesn't mean that they, just won't. That still doesn't mean that they're for sure not going to cut, right? They're still heavily lean towards them, cutting by 25 basis points. But, if we start to see inflation continue to tick up, which, if you guys have been joining this live stream every single day, I've been just repeating this because it's worth repeating and reminding people that, not only our team, but also as well, the Cleveland Fed is also showing that their nowcast is having inflation reaccelerate as well. So, yeah, the inflation problem is something that the market is pretty much trying to price in here. And this has gotten the dollar up to its top end of the trading range. It still remains bearish, but this pop in the dollar, things that are oppositely correlated to the dollar have not been liking this. And then same thing with bond yields, specifically the 10-year U.S. government bond yield. And a lot of people were sending me screenshots again in early August saying like, hey, look, bond yields are dropping. And I'm like, well, hold on. This is just getting down to the low end of the trading range where historically over the past several months, pretty much the past 9 months, whenever the 10-year gets down to 4.2%, the inflation stickiness gets repriced into the market and it gets bond yields back up. And then it gets up to around 4.5%. And then growth scares and recession scares start to come back. And then also, too, you have the crazy amount of government bond buybacks from the government doing it itself, right? So the government, in a way, is doing its own type of Japanese yield curve control, and it's buying back its own debt, right? So it's issuing debt to buy back its own debt. yeah, it's almost like if you had to, go into a new credit card in order to buy out your old credit card, right? So yeah, that's what the government is doing, and obviously the government doesn't do these types of things unless it's in real trouble. But it's masking a lot of the volatility. Now, volatility has been spiking up over the past couple of weeks. As we take a look at the volatility index of the S&P 500 here, it did spike up towards the beginning of August, and then it came back down, and now it's rising a little bit back up. Still well below, 19 through, the early 20s here, this kind of range right here. So, I mean, you know, we could see a volatility spike in the near short term. There's no way, nor do I try to predict the short term moves in the market. That doesn't help anybody. That doesn't help me. Or if I was one of these YouTubers who only banks on doing these types of prediction posts, then yeah, then maybe that would benefit me. But I don't, make these videos just to make videos. I make them because not only does it help me keep up to date with presenting this information, but also as well, pretty much everyone here is actually trading, right, in the markets. And so yeah, I mean, there's no point in really trying to predict this stuff in the short term, but the VIX still remains in bearish trend here. Now that could change. We'll see what happens. But it is interesting how we're going into the Jackson Hole speech tomorrow with rising inflation, or with rising volatility. I wouldn't be surprised if we had some type of flash correction with a jump in volatility there. If that flash correction happens, and if that flash correction happens, I will be looking for bullish trends that are also having a correction, right? So the whole point of our process is whenever these corrections happen, which ones are maintaining their bullish trend and are on lower volume. And as well, other things that are also in bullish trend that are having a correction that are in a favorable macro environment, are we seeing a similar set there, right? So those are the ones that you want to focus on. Okay, just because a market correction happens doesn't mean you just go out and buy everything. You have to be very specific based off of the different indicators that we look at. And so our team is going to be, definitely focused on that tomorrow. If you guys would want some insights on that, we have our free trial with our macro investing community. So even if you just wanted to join for free, just to get the info from what we're going to do tomorrow, the link is in the description below or in my bio there. All right, so taking a look at Bitcoin, interestingly, you're having a continued correction here in Bitcoin. It's getting close to previous resistance levels. So I mean, this still remains in bullish trend, but Ethereum is, out of the two of those, the one with a way better bullish trend. And it doesn't take a genius or some type of Wall Street person to notice that. I mean, just look at the difference in the charts here, right? Not that hard. All right. Now let's take a look at the S&P 500 here, specifically the SPX. So it hasn't yet gotten down to the low end of the trading range. The low end of the range here is 63.30 at the top end of the low end of the trading range zone. And the bottom end of the zone there is 6,300. Nearly on the dot there. So, you can still maintain these levels and have a bullish trend still. So we'll see what happens. If you take a look at Qs, this did have a couple opportunities here at the low end of the trading range. So you do have that there. And then obviously this is being led by a lot of the mega caps that continue to have a bit of a correction here, like Microsoft, Nvidia, Amazon, all these big names where the market is very hyper concentrated into these large names. So yeah, it's not surprising that the market is having a pullback when the majority of the Mag 7 or the top 10 stocks are also having a correction here. Yeah, so that's pretty much what I'm seeing here. Dollar at the top of the range, yields at the top end of the range. I wouldn't be surprised if we have a Jerome Powell that comes on TV tomorrow and really tries to calm some of the spikes and volatility. Or he could just come out as hawkish Powell. Who knows? We really don't know what we're going to get. But typically, he likes to be the salesperson for the market to try and convince them that the markets are going to remain relatively stable and that everything is okay. So we'll see what happens tomorrow. I will be going live for the Jackson Hole speech tomorrow. That starts at 10 a.m. Eastern time. I will be going live a little bit beforehand. Usually I like to go live like 15 minutes before, just so that we can go over everything that I'm seeing in the markets and answer any questions beforehand, before the actual speech starts up. So let's just say we'll go ahead and let's just say, and I'll post about this too, but we'll go ahead and go live tomorrow at 9:45 a.m. Eastern time. All right, so 15 minutes before the Jackson Hole speech begins. And with that, let's go ahead and get into some of the questions here. We will start with YouTube. What's up, YouTube? How we doing? Hope everyone is doing fantastic today on this Thursday. All right, let's go ahead and take a look at the first question here. Boss Todd, what do you make of this MIT study that's saying 95% of AI projects aren't producing returns? I mean, I believe that. I mean, it's kind of like the dot-com bubble where everyone is trying to, break into the internet scene with their own websites. But I mean, that makes sense because most of the AI projects right now are capital expenses, right? It takes a while before capital expenditures become income, right? It's called an ROI for a reason, a return on investment. So you're seeing a lot of investment side and not yet a return side that's still yet to remain, but we'll see that as time goes on. But yeah, so not surprised by that. That's kind of how investment works. How are you incorporating tips into your strategy, if at all? If so, what maturities are you targeting? Yeah, I mean, you can take a look at tips. You can take a look at some of these other, shorter term yields, but really, what we want to take a look at is what the yield curve is doing, right? So it's not just one specific bond yield. This is really for anything across the yield curve, right? So we'll look at, 1 month yields. We'll look everything from in between that to 30-year US government bond yields, but it's the entire yield curve in general, right? So yeah, we incorporate it into our process by looking at the yield curve. Is uranium still bullish trend in our model? I think so. Yeah, I mean, I would say this is more neutral from where it's at right now, just by looking at it. Let's see. Yeah, so you formed let's take a look at this with volume here. So you had this spike up here on relatively lower volume compared to over here. And then you had a little bit of a spike in volume on that sell-off there. It broke through this level and closed below it. So yeah, the uranium is now neutral from where it's at right now. But that doesn't mean that it can't go back to bullish trend. So yeah. Buying opportunity in consumer staples, or is your team more towards growth and momentum? Yeah, XLP is doing pretty well. It went bullish in our model back here, last week, and so that's provided a pretty decent opportunity. But yeah, consumer staples is bullish, but we're also bullish on growth and momentum as well. So two can be true at the same time, but usually they're not, right? Usually staples is a defensive sector. Can you look at gold and silver? Sure. Yeah, so gold continues its sideways action. Right now it's neutral in our model, and silver is bullish. Good questions. All right, let's go ahead and go over to Instagram here. Where do I find this website /data? I think when you commented that, you were referring to the CME Group FedWatch tool. Just Google that, you'll find it. Tradingeconomics.com is also a great free resource as well. Does your model contemplate this macro data, or is it purely technical momentum based? It does contemplate and incorporate the macro data that we're looking at, but you do want to also take into consideration momentum as well as technicals too. So it's not just one thing is everything, right? And this is something that I try and help people understand, is that, like, you don't have to be all technicals, or you don't have to be all fundamentals, or you don't even have to be all macro, right? We have a focus on macro because we want to take a look at these longer trends as it relates to the larger macro business cycle, right? But when it comes to actual positioning and analysis, you want to look at all three: fundamental, macro, and technical, right? You don't just have to be on one team. You can look at everything, right? So, yeah, these are tools. It'd be like saying, well, when it comes to building a house, I only like to use a hammer. That's my thing. That's the only thing that I like to use is the technicals hammer, and I'll continue to do that. Well, how's that worked out for you over the long term? Maybe it has worked out for you, but you know what? Maybe you're not going as fast as you'd like, or maybe you win a bunch and then you lose a bunch, and the technicals are just maybe you don't have time for them, whatever. So it's important to use other tools in the toolbox, which are macro as well as fundamentals. So use everything. Don't limit yourself. Hasn't quantitative easing stopped? Trying to understand if it's still from COVID print. Well, you have to look at where the type of quantitative easing is coming from. Has it stopped from the central bank? Sure, but it's still coming from the government. All that bond issuance that the government is doing by printing treasury bills at the front end of the curve, yeah, that's a form of shadow QE. And you've been seeing that pretty much since 2023 with this liquidity level here. So here's central bank liquidity. Over the past couple years, it peaked on September 10th, 2021. And then it continued to decline into 2022. And then it bottomed in late September of 2022. What does this chart look like to you guys? Again, this is just purely central bank liquidity. This isn't any type of stock or anything like that. This is just purely looking at the reverse repo facility, the Treasury General account, as well as bank reserves. How about this? This red chart is Bitcoin. Isn't that funny? So for people who say, oh man, Bitcoin's having a heck of a run, well, central bank liquidity has also gone absolutely crazy during that same time. All right. And yeah, a lot of that has come from the drain, which continues to happen right now, of the reverse repo facility, which is almost near zero, right? So nearly $2 trillion in shadow QE has been dumped in the markets over the past 3 years. So it's no surprise that Bitcoin is, doing crazy numbers, as well as the general markets are doing crazy numbers. All right. What's your take on the euro Japanese yen? Well, let's just take a look at those versus the dollar, right? The euro has lost a tad bit of momentum, but it still, remains relatively bullish slash neutral. And then the Japanese yen versus the dollar is bearish. So let me change those actually. So put that in red. Yeah, so the euro is bullish versus the Japanese yen. Let me see if they have a pair here. Yeah, euro versus the yen is still, it has lost some momentum, but it is remaining in a bullish trend. You heard S&P 500 follows M2. Yeah, the rate of change, sure. M2 is definitely part of it, but it more so tracks the central bank liquidity curve that I just showed you. What about pharma stocks like LLY, the sector in general? Yeah, interestingly, when it comes to the healthcare sector, um, well, actually, with pharmaceuticals, yeah, Eli Lilly still remains in a bearish trend here. But when you take a look at the sector like XLV, that's been in a pretty decent bearish trend, pretty much the entire year or so. Really since right here back in October of last year, it's been on a huge bear market. It went bullish briefly during this time period between January of 2025 until March of 2025. And then ever since then, it's been pretty much bearish until right now, where it did break through this mark right here. And it looks like it's closing above that. So this would officially turn healthcare neutral in our model instead of bearish, which is a positive rate of change. So we'll see if that continues. Zoetis Animal. I'm not sure what that company is, but I'll look it up here. Am I spelling that correctly? Zoetis. Okay. Yeah, this is definitely bearish trend. Within your model, do you find ranges get tight when volatility is higher? No, actually. The ranges are wider the higher volatility is, right? That makes sense. As something has crazier whipsaws, you're going to have a larger range. Gold miners continuing bullish trend. Any macro reasoning? I mean, you're asking me for a reason why things are happening, which doesn't really matter at the end of the day. What matters is that it's maintaining its bullish trend, and volume and volatility are signaling that it'll remain in a bullish trend here. So, I mean, I could give you a bunch of reasons why, but it really doesn't matter too much. So yeah, I mean, the very strong bull trend. It's just a way of me saying, like, still in this stagflationary environment, gold miners could be doing well. Who knows? I don't have the exact answer for you, but the point is that it doesn't really matter why. All right. Well, we'll go ahead and wrap it up there, everyone. I appreciate everyone for joining. Again, we're going to be going live tomorrow at 9:45 Eastern time. That's actually 15 minutes after the market opens, and also 15 minutes before the last Jackson Hole speech by Jerome Powell. So I'll catch you guys tomorrow morning. Have a great rest of your afternoon/evening/morning if you guys are watching from a crazy part of the world. And I will catch you in tomorrow's Jackson Hole speech analysis. Bye, everyone.